Hello, everyone, and welcome to Intermediate Accounting 2, Chapter 18. Chapter 18 is split up into 3 videos. There's 3 steps involved. So this video is going to be talking about step number 1, which is determining taxable income. So Chapter 18 is all about accounting for income tax. So what you've been doing so far is accounting for to figure out what your net income is. What we're going to try to do is figure out how much tax would have to be paid in a certain year end. So just to give you some context, here I've pulled out Canadian Tire's financial statements for 2019 year end. So the consolidated statements of income. What you have been doing so far in Chapter 1 to Chapter 17 of Intermediate Accounting 2 is you've been figuring out how to get income before taxes. Okay, so your income there before taxes is 1,182. So you already figured out how to get, how to record the revenue, how to record the costs, and figured all that out, the expenses and revenues, and you know how to get to net income before taxes. What I'm going to teach you today is how to figure out this income tax expense. Okay, so there's income tax expense of 288 here, which makes your net income down to 894. So what we're going to do in Chapter 18 is figure out how do we get to these income taxes. And if we look at Note 16 of Canadian Tire's financial statements, so the Note 16 is splitting up and explaining where this income tax expense came from. So this 288 that we saw on the income statement, that comprises of current tax expense and a deferred tax expense or benefit. Okay, so current income tax and deferred tax expense. So what we're going to do in this video is determine how do you get current tax expense, and then the next video will determine how do we get deferred tax expense. Okay, so what we want to figure out is what is the income tax expense for the year? How do we get to this? How do we find out the current tax expense number? Okay. What goes on when you're looking at ASPE and IFRS? So you've learned all the accounting rules, or most of the accounting rules for ASPE and IFRS, and you know how to get to accounting income or net income. When we're figuring out how much tax you need to pay, you have to pay tax not on accounting income, but on taxable income. Okay? The Income Tax Act tells you how to get to taxable income. So IFRS and ASPE, which you've been learning so far, tells you how to get net income or accounting income, but the Income Tax Act explains how to get taxable income. So what we want to do is figure out how do we find out taxable income so we can find out how much tax to pay and how much tax to record. Okay? So like I said, there are 3 steps in accounting for income tax. Step number 1 we're going to be doing in this video, that is determine the taxable income and current tax expense for the year. Step number 2 is to determine the deferred tax. So deferred tax, there is an asset or a liability. So we're going to do that in the next video. And then the third video for Chapter 18 is going to let you know what to do if you are accounting for tax losses. So this video is going to look at determining taxable income. So I'll show you the steps in how to determine taxable income, and then we'll look at it one by one. So the first thing you do is start with accounting income, net income before taxes. You all know how to do that. You have your revenue numbers, your expenses, and then you have your net income. So you're going to start with that, and then we're going to adjust it to determine what taxable income is from the Income Tax Act. So we're going to adjust the the net income amount for permanent and temporary differences. I will explain what these are in the next few slides, but basically you start with net income, and then if there's any permanent differences between IFRS and ASPE and the Income Tax Act, we're going to adjust for those. And then if there's any temporary differences, so temporary differences are differences in a certain period, then we're going to adjust for those as well. And when we adjust for those 2 types of differences, we're going to get to taxable income. Okay? So we're going to find out, this is how I get to net income, but what's the difference between IFRS and ASPE and the Income Tax Act? Like, what are the differences? And so those are permanent and temporary differences. And then we're going to find taxable income. Then what we're going to do is we're going to take our taxable income and multiply it by the current tax rate, or what our estimated tax rate is. And then we're going to get the current tax expense for the year. And we can do our journal entry to record our current tax. Okay, so first step is, so you get your income, net income for accounting purposes, and then we're going to adjust for permanent differences. So what a permanent difference is, it is an item of revenue or expense that you include in either accounting income or taxable income, but you never include it in both. So something that's allowed to be recorded in revenue for IFRS and ASPE, but the Income Tax Act says that these are not allowed to be recorded. Okay. So a couple examples is dividends received from Canadian corporations. So when you receive dividends, you're going to record that in revenue when you're looking at IFRS and ASPE and determining accounting income. But in the Income Tax Act, it says that you do not have to pay taxes on dividends received from Canadian corporations. So what we're going to do is take out the dividends received from the Canadian corporations. So we need to deduct it from accounting income in order to get taxable income. Another example is proceeds on life insurance policies. So if the company has life insurance policies for its key executives, like the CFO, CEO, and something happens to them, and the insurance company pays out a sum of money to the company, that gets included in revenue items or other income. What the Income Tax Act says is this is not allowed to be recorded in revenue for taxable income. So what we have to do is take it out of accounting income, so we have to deduct it. So those were revenue items that are permanent differences, so revenue either to be recorded in accounting income or taxable income, but never in both. There's also some expenses that are allowed to be deducted for accounting purposes, but not allowed to be deducted for tax purposes. So an example of that is fines and penalties. So if you get fined because you paid your taxes late or have some penalties because of that, that is something that you are allowed to deduct for accounting income. So under your expenses to decrease your accounting income, but you're not allowed to deduct it to decrease your taxable income. This is because if you had deducted this, then you would get a lower taxable income and pay less tax, which the Income Tax Act said that that's not fair to do. Okay, a few other examples are golf or social club dues. So if there's membership dues for a golf course or something that like the executive members have, that is allowed to be deducted for accounting purposes, but not for tax purposes. So for taxable income, the Income Tax Act does not think that that's a true business expense for you to be able to deduct and lower your how much tax you have to pay. And then another one is life insurance premiums. So similar to the revenue item of life insurance proceeds, where you can't include in revenue any money you get from the life insurance company for life insurance payouts. The premiums that you pay or the company pays every year or monthly for life insurance, those cannot be deducted for tax purposes, and therefore those have to be added back. So any expenses that are allowed to be deducted for accounting income but not for taxable income need to be added back. So you start with accounting income, you add all these things back, and you get taxable income. Okay. So those are permanent differences. So those are a couple examples of permanent differences. There are more examples which you can look at in the textbook, but those are more of the popular examples that I've shown up. Okay. All right, so now when talking about temporary differences, a temporary difference is an item of revenue or expense that's included in both accounting income or taxable income, but at different time periods. So maybe in year one, you can record something in revenue or expense for accounting income, but you can't record that in taxable income until year two, or vice versa. So it's a temporary difference because eventually you'll be able to record the revenue or expense item in both accounting income and taxable income, but it's just going to be in different years or different time periods. Okay, so the difference will eventually get zeroed out, but it's just in the different years. So maybe year one, like I was saying, you can record an expense for accounting, but you can't record it in taxable income until year 3, for example. Okay? So an example of a revenue item is cash received before earning the revenue. Okay? Sorry, cash received after earning the revenue. We'll do before. Next slide. Okay, so cash received after earning the revenue. So examples of this is installment sales. So you do the work and then you have a payment plan where the customer pays in installments. Or looking at percentage completion method instead of completed contract. So percentage of completion, you're recording the revenue before cash is received, assuming cash is received at the end of the contract. Okay? So to understand this a bit more, let's do a journal entry to figure this out. So what would be the journal entry for cash received after earning the revenue? So you've earned the revenue, you can record it in revenue. You haven't received the cash yet. So you wouldn't debit cash, you would debit AR. Okay, so we're going to debit AR and we're going to credit revenue. So we've earned it, we can record it, but we haven't received the cash yet. So this is recorded in revenue for accounting purposes, but for tax purposes, you're not allowed to record the income for this or the revenue for this until you've received the cash. So once cash is received, so once you receive the cash, then you can record this for tax purposes, right? So right now we have too much money in our accounting income because we've recorded this $100, but for tax purposes, we can't record it until we get the cash. So maybe we'll be getting the cash next year. So in that case, we will be able to record it for tax purposes. So right now what we have to do is we have to deduct this out of accounting income in order to get taxable income, because you're not allowed to record this for taxable income until you've received the cash, but it's already been recorded in the revenue for accounting purposes. Okay, so any instance where cash is received after earning the revenue, we have to deduct that amount in order to get our taxable income. Okay. And then let's look at the other side of things where cash is received before earning the revenue. Okay, so cash is received before earning the revenue. So examples of that would be like subscriptions, royalties, rents, rental received in advance, like a prepaid rent or something that you as a landlord are receiving. Okay? So let's just look at what the journal entry for that would be. So you've gotten the cash, so we can debit cash because we have that. Okay, so we debit cash, $100, but we haven't earned the revenue yet. So we haven't done the work yet. So what would we have to credit is unearned revenue. Okay, we haven't done the work yet. So we're going to credit unearned revenue, $100. So for this doesn't go into accounting income because it's going to go into a liability called unearned revenue. So it's not going to be in our accounting income, but under the Income Tax Act, under taxable income, because you received the cash, you can record this in taxable income. And therefore, if we start with accounting income, in order to get taxable income, we have to add this to taxable income. And so cash received before earning the revenue can be recorded in taxable income. Therefore, we have to add this amount in order to get taxable income. And then looking over to the expenses side, so there's going to be some deductions that are allowed in accounting income, but not in taxable income. And stuff like that is warranty liabilities, litigation accruals, accrued pension expenses. So basically anything that has been accrued for, but cash has not been paid, will not be allowed to be recorded in taxable income. So let's just look at another journal entry for an example of this. So warranty liabilities. So at the end of the year, you have to estimate how much the warranty expense is going to be and set up a warranty liability. So you would have warranty expense, debit, and warranty liability credit. Let's say $200 this time. Okay. So this is going to show up in the income statement because we have an expense. So the expense is going to decrease this accounting income. For tax purposes, you're not allowed to, if you just think about the fact that you're not allowed to record estimates for tax purposes. For tax purposes, you have to record what actually happened, not estimated amounts. So this warranty expense, warranty liability journal entry you would do at the end of the year is an estimated amount. So for tax purposes, whatever actually happened is recorded, not estimates. Okay? So we know in accounting income, we do a lot of estimates and record those. Like even like litigation accruals, if you have a contingency, you would record an estimate of how much you have to pay as a liability. Accrued pension costs, we will do that in chapter 19. You'll have a better understanding of why. So I can quickly tell you that accrued pension expenses, you have to do a journal entry for how much pension expense is going to be, but that's not the same as how much money you're actually putting into the pension. So whatever cash is being paid out is what actually goes into taxable income. So because you've recorded this as an expense and this $200 has decreased the accounting income because it's an deduction, you have to add that back. Okay, so because it's decreased it, we're adding that back in order to get taxable income, because you can't record any expenses for estimates for taxable income. Okay, and then also for depreciation is accounting. Okay, so for accounting, you do a depreciation. For tax purposes, you do something called CCA, which you'll see in the next slide. Okay, so for tax purposes, it's called CCA. For accounting purposes, it's called depreciation. So the Income Tax Act doesn't allow you to record depreciation, but it does allow you to record CCA. So we have to add back our depreciation amounts because we would have deducted it in order to get accounting income. So we have to add it back in order to get taxable income. But what can be allowed in tax is your actual amounts that you spent. So the actual amount of cash that's going out. So the actual warranty that was paid, not the estimates, but the actual amount that had to be paid, the actual litigation costs that you had, the actual amount that is going into the pension fund that you had to pay out. So all those can be deducted for tax purposes, and therefore it's for accounting income was probably those estimates. For tax purposes, it's the actual cost. So you would deduct those actual costs. And again, CCA is an allowable deduction under the Income Tax Act. So CCA is like depreciation. CCA is capital cost allowance. Instead of depreciating straight line over 5 years, for example, that you would do with depreciation, CCA has specific percentages of how much you can claim for each type of asset. Okay? So that's allowed to be deducted. So those are the examples of permanent and temporary differences and what you would add and subtract. Okay? So what we'll do now is we'll go through a question. So if you look at question 1 in the Excel spreadsheet. Okay, so for question 1 is going through a few examples, and what I want you to do is determine whether these examples is it a temporary difference or a permanent difference, and then whether it's added to net income or subtracted from net income. So if you start with net income for accounting purposes and you want to get to taxable income, do we have to add that amount or do we have to subtract that amount to get to taxable income? Okay, so for the first one, for financial reporting purposes, the straight line method is used for plant assets that have a useful life of 10 years. And for tax purposes, the CCA declining balance method is used with a tax rate of 20%. Okay. So CCA versus depreciation, at the end of the 10 years, the asset will be depreciated 100%. So the full amount of the asset will be depreciated and all of the CCA will be taken as well. If you keep going at the 20%, like eventually the 20% is going to run out and then everything will be recorded for CCA purposes. So eventually, at the end of the 10 years, your asset value will be fully depreciated or have fully CCA, and therefore there won't be a difference between between accounting and tax anymore, because everything will be fully depreciated. But during those 10 years, you're going to have a different amount for depreciation and a different amount for CCA. So that's why this is a temporary difference. Okay, so it's a temporary difference because right now we're going to have a difference between accounting and tax, but eventually this asset will be fully depreciated, fully used up that CCA. So we're going to have zero for asset at the end. To determine if you have to add these amounts or subtract these amounts, we can kind of quickly put some numbers to this just so we can figure out what is higher, depreciation or CCA. Okay, so if you have an asset value of $1,000, so if $1,000 is your asset, the first one says the depreciation. So this will be depreciation, short form, and this will be CCA. Okay, so we have 10 years, $1,000 a year, sorry, $1,000 in total. So we're going to do depreciation of $100 per year. For tax purposes, we're going to depreciate this 20% a year. We can ignore the half year rule. So if anybody has already taken tax, for simplicity, let's ignore the half year rule. Okay, so in this case, $1,000 times 20% is 200. Yeah, so we're going to take depreciation of 100 and CCA of 200. So right now, our CCA is more than our depreciation. So we're going to add back our depreciation because that's not allowed for taxable income. And then we're going to deduct our CCA. So in total, you're going to be deducting $100 more, right? So you add back this amount, deduct this amount, and therefore you are deducting more. So that's number one. Number two, a landlord collects rent in advance. Rents are taxable in the period that they are received. So the landlord gets money, so he gets cash in advance. The rents are taxable in the period when they're received. So we know that once cash is received, you would record this for taxable income. You wouldn't record it for accounting income until you've earned the money. So until the rent period has happened, you can't record it in accounting purposes. So right now you're going to have a difference between tax and accounting, but once the revenue has been earned, you can record it for accounting purposes, and you would have recorded it for tax purposes once the cash has been received. So therefore, you wouldn't have a difference in the future. And if there is if the difference is going to cancel each other out in the future, then it's a temporary difference. So here, this collecting the rent in advance, the journal entry for that, so is going to be you receive the cash and unearned revenue, right? We did this journal entry on the PowerPoint. So cash, debit, unearned revenue, credit. That means that this doesn't show up in accounting income because this doesn't hit the income statement, but you are allowed to record it for tax purposes. So we're going to add this amount. So we start off with accounting income. We're going to add this amount to get taxable income. Next one, non-deductible expenses that are incurred in obtaining income that is exempt from taxes. Okay, so non-deductible expenses, so they are incurred in obtaining income that is exempt from taxes. So it's already telling you that it's exempt from taxes. We can't deduct this for tax purposes, but it was incurred in obtaining income. So IFRS and ASPE say you can expense this for accounting income. Okay? So we're never going to match up here. So it's non-deductible expenses, which means for tax purposes, we aren't ever allowed to record this, and therefore this is a permanent difference. For expenses that have been deducted for accounting income, in order to get taxable income, what you need to do is add it back because they were deducted to get accounting income. We have to add it back in order to cancel it out. Next one, cost of guarantees and warranties are estimated and accrued. Okay. So estimated, we don't like, tax doesn't like estimates, right? So estimated and accrued, for tax purposes, they don't like things that are estimated, but eventually they will. So eventually, for tax purposes, when this is actually paid, you can record it for tax. But right now, we know that this is expensed for accounting purposes, can't be recorded for tax purposes until it's actually paid. So therefore, there is a temporary difference that will cancel each other out in the future. So if this was a cost that was deducted to get accounting income, we have to add it back in order to get taxable income. Okay, so for number 5, if you're looking, installment sales are accounted for by the accrual method for financial statement purposes and the cash basis for tax purposes. The revenue amount is higher than the cash received. Okay, so we have installment sales, we've recorded the revenue for it, but we can't record it for tax purposes until cash is received. So eventually we will record it for both accounting and tax, but just not in the same year. So this is a temporary difference. And it says the amount of revenue is higher than the cash received. So there's too much revenue in the accounting income, and therefore we have to take it out. So we have to deduct it. For number 6, for some assets, straight-line depreciation is used for both financial reporting and tax purposes, but the asset lives are shorter for tax purposes. Okay, so depreciation versus CCA, we already know that that's a temporary difference because at the end of the asset's life, both will be, depreciated 100%. It says the asset lives are shorter for tax purposes. So if asset lives are shorter, that would mean, so for example, if you have $1,000 as your asset, and we were to do this example where you're depreciating over 10 years, it's going to be 100. But if you're depreciating over 5 years instead, so your asset life is shorter, then it's going to be 200. So same example as above, 100 for depreciation, 200 for CCA. So in the end, you're deducting $100 more. So you're adding back the 100 for depreciation, and you're deducting the 200 for CCA. Number 7, pension expense is reported on the income statement before it is funded. Pension expense is only deductible when it is funded. So funded means when it's actually paid to the pension fund. So you have, for accounting purposes, you have to record pension expense, and that's not necessarily the same amount that actually goes into the pension fund, which in chapter 19, all this will be explained in much detail. Okay, so you record pension expense before it is actually, the cash is actually provided into the fund, and pension expense is only deductible for tax purposes when cash is actually paid out. So again, this would be a temporary difference. You have a difference in accounting and tax, but eventually it will be zeroed out. And it says that we've reported pension expense for accounting purposes. So in your accounting income, this has been deducted. So in order to take it out, we have to add it back. Number 8, proceeds are received from a life insurance policy because of the death of a key officer. The company carries a policy on all its key officers. Okay, so for life insurance, we know that this is not allowed to be deducted for tax purposes, only for accounting purposes. So never will you be allowed to deduct, this is a proceed. So never will you be allowed to record proceeds from life insurance companies in revenue for tax purposes. And therefore, that makes it a permanent difference. And so this is money that's coming into the company, so it's going to increase your accounting income, but we can't record it for tax purposes, so we have to take it out. We have to deduct it. Number 9, company reports dividends received from a taxable Canadian corporation as investment income on its income statement, even though dividends are not taxable. Okay? So here, dividends have been received from a Canadian company, and for accounting purposes, we've stuck it in investment income. Okay, so it's an investment income in our income statement, but we know that for tax purposes, we aren't allowed to, we don't have to pay tax on dividends received from Canadian corporations, and therefore this is a permanent difference, so you never would have to pay tax on this. So you would never include this in taxable income. It's already been included in accounting income, so we have to take it out, deduct it in order to get taxable income. And then number 10, estimated losses on pending lawsuits and claims are accrued for financial reporting purposes. These losses are tax deductible in the periods when related liabilities are settled. So the for tax purposes, when it's settled, which means when cash has been paid out, that's when you can record it for tax purposes. But for accounting purposes, we do have to accrue this. Okay? So eventually, we will be able to record this for both accounting and tax, just in different time periods. So temporary difference, and this was accrued on the financial statements. So this deducted accounting income, right? So this is an expense that brought down accounting income, and therefore, in order to get taxable income, we have to add this back. Okay. So I hope this example or this question has made sense to figure out what's a temporary difference, what's a permanent difference, and you add it or subtract it from accounting income in order to get taxable income. Okay. So like I said, the steps in order to get taxable income, you start with accounting income, net income before taxes. Then you're going to adjust for your permanent and temporary differences, right? So add back and subtract your permanent and temporary differences in order to get taxable income. You're going to take your taxable income and then you're going to multiply it by the tax rate. So the current tax rate is going to be an estimate. The tax department of your company can figure out how much tax is going to be paid and get a tax rate. And you can multiply that taxable income by the current tax rate, which gets you the current tax expense for the year, and then you do your journal entry. Okay, so let me just show you what your journal entry would be like. So after you figure out what your current tax is, your journal entry for this is going to be a debit. Oops. So it's going to be a debit to current tax expense. Current tax expense, and it's going to be a credit to income tax payable, okay? Because you're going to eventually have to pay this. Okay? So we can list it as a payable, and when the actual taxes are done and you have to pay this amount, you can reverse that. Okay? So debit current tax expense, credit income tax payable, which is a liability, a current liability. Okay, so that's what you would do at year end for step number 1. Okay, so step number 1 ends at doing this first journal entry for the current tax expense. All right, so let's do another question. It's always good to have an example so you know how to do this. So question 2, part A and B, we're just doing for now. And if you go into the Excel, go to question 2. And you can work on question 2. So I would recommend that you pause this video and work on this question. And then once you've finished trying to do it, come back to the video and see how the solutions, what the solution is. Okay, so try it yourself first. Pause this video, try to do it, and then compare it with your answers. Okay, but we're going to take this up right now. So here, so Melissa Inc. has accounting income of $105,000 for its first year of operations. There's some amounts that cause a difference to income reported on the financial statements. So property, plant, and equipment was purchased at the beginning of 2014 for $300,000. Depreciation of $40,000 was taken, and CCA was $56,000. So we know we have to start with accounting income, right? So that's your starting point. We have this difference, and this is when you're looking at whether it's a temporary difference or a permanent difference. We know that this is a temporary difference because eventually the $300,000 will go down to 0 for both tax and accounting. So we have to add back our depreciation, deduct our CCA. Number 2, rent revenue reported on the tax return is $24,000 higher than rent revenue reported on the income statement. Okay, so I guess we have gotten some prepaid rent. So we've gotten some rent in advance. So we have $24,000 in cash that we got in advance. We haven't earned that revenue yet. So that's why it's on the tax return, but it's not on the income statement. Again, this would be a temporary difference. And then you would have to add this $24,000 to show your taxable income. Number 3, non-deductible fines appear as an expense of $15,000. So they got fines or penalties from maybe doing their taxes late in a previous year. So it's showing as an expense on the income statement, but we know we're not allowed to record this for tax purposes. It's a permanent difference, so we would have to add that back. Dividends received by Melissa Inc. amounted to $10,000. Okay, so we're going to assume that these are dividends from a Canadian corporation. This was recorded in investment income for accounting purposes, but it's not allowed to be recorded for tax purposes. So we have to take that out. We have to deduct it. Okay? And the tax rate is 30%. All right, so part A says calculate the taxable income and current tax expense for the year. So we start with accounting income. We said that was 105. And then we're going to deal with our permanent differences. Okay, so our permanent differences, we had 2, number 3 and number 4, non-deductible fines. So this is an expense on the income statement. Therefore, we have to add it back. And then the dividends received is a revenue amount on the income statement. So we have to deduct it. Okay, so those are 2 permanent differences. Temporary differences, we have a couple of those, depreciation, CCA. So we have to add back the $40,000 of depreciation and subtract the $56,000 that we are allowed to record. So we add back what we're not allowed to deduct for tax purposes and deduct what we are allowed. Okay. And then we had number 2, this rent revenue. So this rent revenue, we recorded it on the tax return because we got some cash in advance of earning the revenue. So it's not included in this $105,000, but we have to add it. So we're adding that $24,000. So we start with 105, adjust for our permanent differences, adjust for our temporary differences, and in total we get $118,000 as our taxable income. So what do we do with this next? We're going to multiply it by our tax rate to get our current tax expense for the year. So multiply by tax rate 30%, and $35,400 is how much tax expense we have to pay. So that's going to be our current tax expense. Part B says prepare the journal entry for current tax. So I showed you guys the journal entry here. Debit current tax expense, credit income tax payable for $35,400. So basically what you have gotten from doing your calculation. The last amount, current tax expense here after doing the tax rate, gets you this, this number here. All right, hope that made sense, and hopefully you guys got this number, or got close to this number. All right, so that is the end of video number 1, step number 1 for chapter 18, which goes through determining your taxable income and current tax expense for the year and doing the journal entry. Okay, the next video we'll go through step 2, talking about the deferred tax expense. So this is current tax expense, and then we'll talk about deferred tax expense. Okay, so thank you for listening and take care.